transactions to a journal. Okay, and so we learned in chapter 2 and 3 how to create a journal entry to post into a journal. But this chapter is all about what type of journal is that? What type of journal do we put our journal entries into? And then after we post a journal entry, we may also have to post it to a ledger. So which ledger do we need to post it to, if there is one? Okay, so there are 5 main journals and 2 ledgers. We're going to call these ledgers subsidiary ledgers. Because we have a main ledger, it's called the general ledger. And the general ledger is the big ledger that all of our transactions are going to be posted to. But we have some sub-ledgers that are just lists to help us keep up with who owes us and who we owe. So let's start with the journals. There are 5. The first one is the general journal. Now the general journal has 2 main purposes. They are going to be to post our adjusting journal entries. So at the end of the month and the end of the year, we may want to post depreciation expense, adjust for prepaid expenses like supplies, adjust for unearned revenue, or any other accrued expenses or accrued revenue. So if we are going to post adjusting journal entries, those need to go in the general journal. The general journal also has a second purpose, which is to post our closing entries. So you learned in chapter 4 how to create the 4 steps of closing entries. Well, when you post those to a journal, they go in the general journal type. And I like to abbreviate the general journal with a GJ. Okay? Second type of journal is the revenue journal. So we're only going to post in the revenue journal when we're providing services on account. So this is very important to realize that we're providing services and we didn't get the money yet. So on account means we're going to get paid later. So when we get paid later, that means that we have to post it to the revenue journal. When we sell products on account, so this is either services or we're selling stuff, products, on account, no cash has exchanged hands yet, that goes on the revenue journal. But if we did sell services or products and we did get paid, so cash is received, then it's going to go in the cash receipts journal. So I like to indicate the revenue journal with an RJ when we didn't get the cash yet, or a CR, cash receipts, when we did get the cash. So both of these 2 journals, we're running out of room, are on the revenue cycle. We're talking about selling stuff and making money. Okay, so the cash receipts journal, we receive payment for sales or services. Okay, possibly it was put on account here, so we made a sale and we debited accounts receivable and credited fees earned. Okay, so we're going to debit accounts receivable. Well, we have to keep up with who owes us in accounts receivable. We may have many, many people that we are providing services to, so we need to keep a list of who are those people who owe us. So this is where the subsidiary ledger comes in. So if we debit AR, anytime we debit AR, we're going to add to a subsidiary ledger. And this is going to be our accounts receivable subsidiary ledger. Now, later, we're going to get paid. So we're going to have to take it off the subsidiary ledger. So anytime we credit accounts receivable because we got paid, we debit cash and credit accounts receivable. Then we would take it off the subledger. Okay, so the accounts receivable subsidiary ledger goes in the revenue cycle for when we are going to get paid later, and then we finally get paid. We have to keep up with this list. So here's kind of an example of what that might look like. So let's say we have a balance sheet. We've got some cash. We've got accounts receivable and equipment. Cash, accounts receivable, equipment. Total assets of $33,500. Well, when we're looking at the balance sheet, we can't really tell who owes us this $12,500. So we need to create an accounts receivable subsidiary ledger, which is a list. So all it is a list of who owes us. So we have client number 1 might owe us $2,500, and then client 2 owes us $10,000. So there's our total $12,500, which is just going to be the list of people who owes us that balance on our balance sheet. So whenever we have someone who we provide services to and they don't pay us, we're going to put them on the list and post to our revenue journal. So two things, the journal and the ledger. Then later when they pay us, we need to take it off the subledger because they paid us, and then post it to our cash receipts journal. We'll do an example in a minute. The last two types of journals are in the expense cycle. So the fourth journal is the purchases journal, and the fifth journal is the cash payments or cash disbursements journal. I believe your book calls it cash disbursements journal, and I like to abbreviate that with CD. Disperse means to pay. Purchases, I like to abbreviate with PJ, purchases journal. So when we make purchases on account, that means we buy things, but we don't pay for them with cash yet. So we have to maintain a list of who we owe because we're probably making lots of purchases. So here we're going to credit accounts payable, and our debit is some expense account. Whenever we credit accounts payable, we have to add it to a list. We're going to call that the accounts payable subsidiary ledger. We might purchase on account office supplies, equipment, inventory. Those are just some common things. Well, then later, we could pay for these things, and we'll be issuing a check, so disbursing money. And so this could be, right up front, we pay our rent, it never hit accounts payable, so we never put it on the ledger, and that's fine. We just issue a check for something. It's going to be our cash disbursements journal. But if we previously put it on the accounts payable subsidiary ledger because we credited AP, and then later we paid it, we need to take it off the subsidiary ledger. The accounts payable subsidiary ledger. This would be when we debit accounts payable. And our credit, of course, would be the cash. So this is the two journals that go in the expense cycle, and the subsidiary ledger that goes with them is the accounts payable subsidiary ledger. Again, this is just a list of who we owe, and it would look something like this and correspond with our balance sheet balance. We'd have $25,000 over here on our balance sheet, but we don't really know just by looking at that balance who we owe. So we're going to look at our list our subsidiary ledger to find out. Whenever we pay somebody, we're going to take it off the list. So here's some examples. Let's say on June 1st, we issue a check number 320, to pay our rent. So we don't have to pay anybody later. We just went ahead and we issued a check. So we are dispersing our money. So we're going to put this in a cash disbursements journal. Now every transaction goes in a journal, but not every transaction has to use a subsidiary ledger. We only use our subsidiary ledger when we're either going to pay later, or we're going to get money from our customers later, or if we got paid, or we pay something that we owed previously. Well, here we issued a check. So the money has exchanged hands, and we didn't have this owed previously. So on June 1st, we don't have to hit a subsidiary ledger. On June 2nd, we purchased some office supplies on account from Textile Company for $3,900. So since we made a purchase and we didn't spend the cash yet, this is going to go on our purchases journal. So not cash disbursements, because we didn't pay for anything yet. Purchases journal, and we pay later. So since we're paying later on account, we need to use our accounts payable subsidiary ledger to keep it on the list, so we make sure to pay for it at a later time. On June 8th, we provide services on account to Whistle Company using invoice 39 for $800. So we provided services, so we made some revenue, but we didn't get paid yet. So that journal is going to be the revenue journal. It can't be the cash receipts journal. We didn't get the money yet. So use the revenue journal to show we did make money, but we didn't receive it. So we're going to receive it later, then we have to put it on our list for accounts receivable, which will show it later. Okay, that's our subledger. On June 12th, we issued check 321 in payment of supplies we purchased from Textile Company on June 2nd. So here on June 2nd, we put it on the list. We added it to our subledger. And on June 12th, we paid for it. So there's two things. We have to first figure out the journal. Well, if we're issuing a check, we're dispersing money. So that's cash disbursements. And it was previously on a list, and we need to take it off. So we're going to take it off accounts payable list. So it will affect our subsidiary ledger for accounts payable. On June 18th, we received $800 in payment of our June 8th invoice. So here on June 8th, we said we'll receive that money later, so we added it. And then now we've received it. So not only are we going to have to hit our cash receipts journal because we've received some cash, but we need to take off our accounts receivable off the list, so it will affect our ledger. And then on June 30th, we journalized some adjusting journal entries prepared for the month end. So this is going to affect our general journal. Now this will affect many subledgers because we'll accrue expenses and we will accrue our revenue. So this is going to affect our accounts receivable and our accounts payable journals. So both. Okay, so if you look at page 236 in your book, there is 20 or so examples, just kind of written just like these, where you'll have to indicate which journal in which subledger. And then the answers are also at the bottom of that page. So what you should do is cover up the answers at the bottom of the page and work through each one on a separate sheet of paper, and then check your answers to make sure that you are able to identify not only the journal, but if you need a subsidiary ledger, and then if so, which ledger do you need to adjust? Okay, so that's pretty much the gist of Chapter 5. At the end of Chapter 5, there's, I put this in your reading, there's a discussion of e-commerce, which is, transacting over the internet, which I'm sure you're all very familiar with, and using Amazon or buying items online, even eBay. It makes a distinguishes between transactions from business to business or business to customer. So do make sure to read over those. I made a little note here about blockchain. If you've heard of blockchain in the news or in the media, blockchain is a new way that we will be transacting, and I'd just like to mention it because this is going to affect how our e-commerce currently operates. It's not mentioned in your book, but blockchain will be something that starts changing our e-commerce business to business and business to customer. And we'll start Chapter 6 in the next video.